Okay, so let's make a full breakdown of the situation that we currently have on gold. Now, starting here from the monthly, we can see how the market has just created a very strong impulse to the upside, followed by this complex correction. Now, in general, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse. And if we do that, we can see how the market just created a perfect 0.618 Fibonacci retracement, which is also the golden ratio, which the market tested here and rejected to the upside, and again tested here and started to reject to the upside. And at the moment, as we're testing the 50%, we do expect a rejection higher, possibly even for the creation of new all-time highs. So here on the monthly, everything seems quite bullish. Dropping down on the weekly, what we can see is that in all this impulse to the upside, there is one candle which is not related to the move, which is exactly this red candle here. And as we're testing this strong level of previous resistance turn support, we can expect the market to reject it to the upside, possibly even for the creation of a higher high. So here on the weekly, everything seems quite bullish. Dropping down on the daily, what we can see is that we did have the creation of this M pattern. And in general, after the creation of an M pattern, you want to see the market create a move to the upside to go and complete the pattern itself at the previous support turned resistance. So here on the daily, we do expect a rejection to the upside for the market to go and complete the pattern at this previous support turned resistance. Now, if we look at what happened here, we can also see how we did have this horizontal accumulation, a stop hunt with the market creating this rejection lower, and at this point, hedge funds and the big players had the liquidity to actually create this move to the upside. And at the moment, we did have a break and retest of structure. In fact, we currently have previous daily support here, turned resistance here, and again here, which now that the market has broken to the upside is again supported this area, and we can expect the market to reject this zone to the upside. Now, if we go and see what we have from a COT perspective, so commitment of traders, which is basically what hedge funds and the non-commercials in the market are doing, we can see how with the last reports net positions have been increasing. We went from having 168.3k net positions up to having 202.4k net positions with 298k longs and only 95.7k shorts. So gold is very bullish at the moment. And we can see that also reflected in the price action with the accumulation forming, break and retest of structure, and the monthly and weekly to look quite bullish. So, how we will be approaching this potential short term longing opportunity here with students for the market to at least go and potentially complete this M pattern at the previous support turned resistance. Now, as usual, monthly, weekly, and daily combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, with students, we will be monitoring price action from an intraday perspective inside of this area, waiting for the market to shift from an intraday bearish market as we will have to an intraday bullish market. And as soon as the market will shift from an intraday bearish to bullish market and provide to us one of our valid entries, at that point, we could be looking for a potential long with a good risk to reward and good probabilities for a move to the upside and for the market to complete the pattern at this previous support, turn resistance here on the daily time frame. Now, if you enjoyed this free analysis education and update, make sure that you drop a like and a comment. It really does support the creation of more free analysis education and updates for all of you. And I will see you in my next breakdown.